Good morning, everyone. Thank you for joining us today. It's 10 o'clock. We're going to go ahead and get started. If we can progress these slides. My name is Charla Roth. I am a partner here at Dannible McKee. I'm also a principal with Dannible McKee and Associates. I have over 23 years of experience providing audit, accounting, and consulting services for a variety of our clients. I specialize in working with architecture and engineering firms such as yourself. I have extensive experience working in the FAR arena, Federal Acquisition Regulation. Those are overhead audits for those of you not familiar. I also manage a very large contract with the New York State DOT from 2011 to present. So that's a great experience working for an agency, and also working for engineering firms as yourself. I have a lot of experience working with different accounting packages such as Deltek, Jira, QuickBooks, and much more. So yeah, that's enough about me. But let me tell you a little bit about Dannible McKee. We are a full service CPA firm. We deliver superior outcomes through a combination of our technical knowledge, deep understanding of your business, and our commitment to personal and responsive service. Our clientele consists of companies throughout New York State and the United States. I have clients here in Syracuse, New York, where I'm based. I also have clients all the way over in Alaska and California. And we certainly deal with clients overseas as well. So a wide range technology allows us to be just about anywhere. We are headquartered here in Syracuse, New York. As I mentioned, we have offices in Binghamton, Schenectady, Auburn, and also an office in Tampa, Florida. One of our main specialties here at Dannible McKee is architecture and engineering firms. We provide accounting services, tax, forensic, valuation and advisory services, along with FAR overhead rate audits. We do have a sister company, DM Consulting Group. You may have heard of them as Dannible McKee and Associates. Possibly you've attended one of our valuation or ownership transition seminars in the past. We work with firms throughout the country on transition of their firms, determining the fair market value of their firm, developing creative strategies for ownership transition, and helping you establish buy-sell agreements. So with that today, we're going to get started. Hopefully you all had a chance to sit through my first section of the webinar, which was really just talking about your financial statements and how unique they are as an architecture or engineering firm. And then today is really a deep dive into ratios. We used to put the two sessions together. It was really just a lot of information. So I've started breaking out this training. So hopefully you'll find this helpful. If you didn't attend my last webinar, they're available on YouTube, so you can have a look and familiarize yourself with all of that. But we'll jump right in. I want to preface that if you have any questions, you can put them in the chat. I will try to address them as they come up. If I don't get to any by the end, I will just send you some personal emails to get you back answers. So let's jump right in. Today, what we're really hoping to cover is how you can utilize key financial ratios in your financial statements. Financial ratios are just a numeric calculation that's comparing meaningful amounts to you in your financial statements. Ratios by itself are just not a means to the end. They provide a lot of insight to your firm, but in order to utilize the ratios, you need to understand them and also determine what exactly they mean and how relevant they are to your firm. We're going to talk about benchmarking a lot today. We're going to compare ratios with some of the same ratios for another firm. We're going to talk about comparing different periods of time. We're going to talk about setting some predetermined standard that you want to benchmark yourself up against. We're going to compare some of the same ratios within your industry. We're also going to compare average ratios for your industry. So we've got a lot to unpack in the next hour. So ratios are really broken into different categories. These financial analysts have developed different categories for these ratios, and we're going to walk through those today. So really, I think it's important that you take a mix of a couple different ratios from each category that make sense for your business and intertwine those to your monthly reporting. And we'll walk through those. You'll get this deck slide after. We'll have my marketing department will email it to you. So you'll have that so you can see all the calculations so that you can prepare your financial statements and add them to it. So in addition to some of these categories, there's some general ratios applicable to most companies, but within the A&E industry, you're going to find that there are a lot of ratios that are really specific to you. That's why we teach this seminar. Very different just to A&E firms. I teach this to manufacturers, construction, but this is a very, very specific because you do have a lot of good industry data out there to help benchmark yourself up against. And there are a lot of industry specific ratios to help manage your business. Okay, so industry comparison, we're going to look at the firm's performance in relationship to other A&E firms, give you some ideas on where to find that data. Hopefully, all of you are participating in surveys. That's really important. That if you participate in PSMJ, ZWEG survey, that's just really important to continue to get the data out there of a good cross segment of firms. So again, if you participate, then you get the information back. So it's a great way without having to pay for it. So I mentioned some of the surveys already. PSMJ, they have a great financial performance survey. You got RMA, Risk Management Association. That's another great survey. And then ZWEG, which is another survey, but includes a lot more publicly traded firms. So selecting your industry data, it's going to be really important that you understand where you fall in. I think a lot of like PSMJ, they give you industry, like I have 25 to 50 employees. I have 200 to 500 employees. I'm in the East Coast. I'm in the West Coast. So it gives a lot of great breakdown of the different industries, whether you're just architecture, whether you're just engineering, whether you're a combination of both. So it's got a lot of different industry breakdowns. And I have a little slide later on that you'll see how I tie all those industry ratios in to compare. So the first category, we talked about these categories. We call this a liquidity ratio. It's what it sounds. How liquid are you? It's going to provide an indication of your firm's short-term financial situation or solvency. So how liquid are you to pay down your liabilities within the next year? So this is within the next 12 months. So key ratios within this category are going to be your current ratio, your working capital, your AR turnover, and then your work in process average. So we're going to dive into each of these ratios. Just take a look. Hopefully this is something that you're looking at on a monthly basis of when you're looking at your financial statements to determine where you stand amongst your peers or where you are compared to where you wanted to be with budget. Something that I want to point out is this balance sheet. Now, this balance sheet you're going to see for an architecture engineering firm, your two biggest assets are AR and work in process. So a lot of our ratios, the liquidity ratios, are going to focus around those two assets. Okay. And when we talk about working capital, we're looking at your current assets less your current liabilities. So what do those represent? Your current assets are your cash, your receivables, your WIP. Your liabilities are your payables, any accruals you have, any line of credit, any short-term debt payments that need to be made within 12 months. So We're going to hop into those ratios next, but I just wanted to give you a sense of what makes up your current assets and your current liabilities. Another example of a tool you can use is I like to look at these common size financial statements. And what that means is you're looking at your assets as a percentage of the total. So at a snapshot, it tells me where my assets are concentrated. So 50% of my assets are in accounts receivable. So that's really important for me to know. It's important for me to track. So this is just a nice tool. You don't have to do this every month, but it's a good basis to help understand your business and to track your financials over a period of time. So current liabilities, this is a great tool to see, okay, where do my liabilities exist as a comparison of my total liabilities and equity. And, hopefully your concentration is right down there in stockholders' equity. So let's hop into this ratio. So we talk about a current ratio. I took it without deferred taxes. Not every engineering firm is a C Corp. So really, you want to make sure when you're doing your analysis that you're comparing apples to apples with other firms. So it's helpful to look at the current ratio without deferred taxes. So again, it's current assets divided by your current liabilities. And current assets are your cash, your AR, your WIP. Your current liabilities are your AP, your accruals, and your current portions of debt and your line of credit. So you'll see this company is doing a great job. They're very liquid. Liquidity has declined over the years. And I also included in here an industry standard. So according to the 2025 PSMJ, really it's suggesting that your current ratio should be more of a 3.0. So, I think this is something the company would want to analyze and determine, what's going on with their receivables, with their WIP. Are they billing timely? What's the reason why their liquidity is not as high as maybe the industry standard? Working capital. So this is very similar to your current ratio. It's really just taking what you've got left over with your current assets less any current liabilities. So this is what you're working with. It's in the name. So hopefully this is positive for everyone on the call. But this is something that you want to track and ensure, there's times, obviously, you're going out on your line of credit where receivables may be really high. So it's just important that you monitor your working capital. Certainly, if you have any bank debt or line of credit, the bank is looking at your working capital. All right, so another liquidity ratio that's really important to A&E firms is your days fees in unbilled work in process. So we like to call this, you may have heard it as your average days of work in process. So this is just your WIP divided by the daily fees generated. So this is, for this firm, it's a little bit on the lower side. You'll see they're just under 13 and the median is 18. And the lower, you've got lower quadrants and upper quadrants. So this is something that you're going to want to certainly pay attention to. And, how often you're doing your billings. Is that something that's happening twice a month? Is that something that's happening once a month? This is just a really important ratio to monitor your day's fees, because obviously we all know the lag from the time that we charge the labor to the time that we bill it to the time that we collect it, and all of that plays into your working capital. So it's really important that you're focusing in on that bi-monthly billing with your project managers so that you can keep this next ratio that we're going to work on lower. So this is your average collection. So this is just days, fees, and billed receivables. It's just taking your receivable balance and dividing that by your days, fees generated. So it's just really important to know what your collection cycle is. The collection cycle is obviously very high here. Potentially this is a governmental contractor and this is what they're seeing in their payout. Industry standards on the lower median, 44 days, 62 days in the middle. So this is something you should challenge yourself at to look. If you know that you're in that 120-day mark, because that's just the nature of your clients, it's going to be that much more important that you're doing billing on a much regular cycle in order to collect that money more timely. If you're turning over receivables, twice a year, that's important to know. So this is a good ratio to be constantly analyzing and working to improve it. The next category is leverage ratios. So leverage ratios are really just measuring the extent to which your firm's operations are financed by debt capital versus equity capital. Okay, so it's an indication that what your firm's vulnerability is going to be when you have business downturns. So if you have a lot of debt, a lot of bank debt, these are ratios you're going to want to pay attention to. So this first ratio is just your debt to equity. This is going to include all debt, all liabilities compared to your total equity. Industry medians about 0.66. This firm has a little bit more debt to it. So, that's been constant throughout their life cycle, but this is just something to monitor and to take a look at and understand where your firm stands up compared to the industry. Bank debt. So this is something you're going to want to pay attention to for if you have a line of credit, if you have a mortgage. Not every firm owns their building. This firm here that we're presenting does not. They rent. So there is there's not significant bank debt. If you have a mortgage, that's something that you're going to have to understand. You're not going to tie in with the industry standard. You'll never measure up because most firms in the market do not own and operate their building. Excuse me. So that is something you're going to want to consider. So again, these ratios are not the means to an end, but they are certainly something you need to consider. And when you're comparing yourself to industry, you need to take a step back. Not all firms are alike. What does this mean to your firm? And in this case, maybe comparing this ratio with a history in time is more relevant to your firm. Operating ratios. So operating ratios are going to measure the firm's ability to utilize its resources, generate revenue and profit. This is going to include such resources such as your labor force, your asset base. Operating ratios are going to measure your firm's ability to control costs. Really important. So ratios that you're going to look at are some net income ratios, labor ratios, overhead ratios, staff ratios. So again, a lot of these ratios are going to be pretty specific to AE firms. Let's just dive right into them. Now, if you attended my last webinar, you saw that this is a proper structure for an AE firm of your financials. So if you do not have the proper structure of your income statement, you're not going to be able to compare yourself to industry standard. And what does that mean? So you can see here, I have a couple main categories that are going to be important that you're breaking out. So your gross revenue, obviously, that is what it is. It's your gross revenue. Your reimbursable expenses, that gets deducted out of there to come to what we call net revenue. So net revenue is the basis for everything. When you're comparing how your firm is performing against other firms, it's that net revenue figure that matters. The gross revenue amount isn't going to matter. So it's really important that your financial statements are designed to be able to pull that number right off of it in order to be able to utilize and compare yourself. Now, another figure that we see in a lot of firms that have very canned financial statements that haven't really structured their financial statement to be specific for an AE firm is you're not breaking out your labor. So it's really important that your direct labor and your indirect labor are broken out because we're looking at a lot of labor statistics that are based on direct labor. And so direct labor is really just the labor that's chargeable to a project, not billable to a project, but chargeable to a project, and your direct expenses. So it's really important that those direct costs are broken out of your overhead because we have a lot of these ratios that pick up these numbers specifically. So, if you're getting a FAR audit performed, then you're hopefully already doing that. If your financial statements are not structured in this format, I think now is the time to consider that. We work with a lot of firms in order to get their financial statements structured properly. If you're using a big product such as Deltek or Jira or Clearview, hopefully your statements already look like this. If you are on QuickBooks, there are many tools to reformat your chart of accounts and to present your statements just as such. There's no reason that you have to look like a manufacturer because you're using QuickBooks. We can help you tailor your financial statements to be in this format so that you're able to utilize ratios that are specific to your firm. Yes, so there was a question about whether or not the PowerPoint is going to be available after this. Yes, it will. My marketing team will send this out to you as well as a download to listen to this all over again because you probably want to spend one more hour with me. So yes, they'll be sending that out. So back to this income statement, you're going to see, your gross profit margin. Again, really important that you're understanding the net revenue piece, the direct piece, and then below it is your indirect expenses. So that's your indirect labor. That's, your accounting team, your marketing team, any training time, any vacation, sick, your office expense, coming down to your operating income. And something really specific about AE firms is, not everyone distributes bonuses and profit sharing in the same manner. So it's really important that you segment out your discretionary items such as bonuses and profit sharing so that you can look at your net income before that piece and compare that with industry because not everybody is distributing their returns in the same manner. So it's important that you break out your statements accordingly. So similar to what I showed you on the balance sheet with that common size financial statement, you can do the same thing with your income statement. So you can see that everything is based off of this net revenue figure, not gross revenue, but net revenue. So everything is based upon 100% of net revenue. So where's my concentration? So you can see, 33% is direct labor. That's really important because if you look over, year to year, you're looking at the change and the concentration of your direct labor year to year. And hopefully that is staying fairly consistent with your net revenue. That's the goal, right? Or decreasing. But realistically, maintaining that ratio of direct labor to net revenue is important because that's obviously factoring into your operating income, your gross margin. Your indirect expenses, understanding the growth of, as you grow as a firm, as you grow top dollar, your indirect expenses are going to fluctuate. You have to hire more administrative people. That's natural. But looking at it as a percentage of your net revenue is a great tool to understand where you line up year over year. So let's get into some of those operating ratios. The first one we want to talk about is that net revenue per chargeable hour. So hopefully all of you are tracking your chargeable hours, and that this is something that you can easily pull out of your accounting software, your payroll software, your timesheets, however you're maintaining your timesheets. So net revenue, again, it's not gross revenues, it's net revenue. That's what you're going to use. And you're going to divide that by your total chargeable hours. So your net revenue divided by total chargeable hours is going to get you your net revenue per chargeable hour. So for this firm, you'll see they were at $91 net revenue, but the industry standard is much higher. So obviously, it could mean geographically where you're located, but this is something you want to take a look at. Why are you not measuring up to your industry standard? The good news is you did increase from the prior year, but it's probably not inflationary. So this is a really great tool to look at to see what your net revenue per chargeable hour is, to see if one, you're charging enough, or if B, you're paying your folks too much. The next ratio to look at is your direct labor cost per chargeable hour. So this is just your direct labor. Again, if you are not segmenting your direct labor from your indirect labor and you're just grossing it into one wages category, this ratio is not going to help you. So it's really important that you get a grasp on breaking out your direct labor in order to really break down how you're performing with your peers. So this is just taking your direct labor dollars and taking those same chargeable hours, and then you're getting that net revenue per chargeable hour. Again, a little bit lower than the industry standard. So this is something that you would want to look at from a firm perspective, why that is. And again, it's been stayed pretty flat year over year. So this is a really great ratio to take a look at. All right, net multiplier achieved. Really important ratio for you to understand. This is your net revenue divided by your direct labor. This is the net multiplier is something you're going to want to develop as a firm and monitor. If you're working with a big program such as Deltek or Jira, this is something that should be on your dashboard that you are monitoring on a daily basis, that you're looking at that net multiplier. And again, this is just the net multiplier achieved. It's just taking your net revenue divided by direct labor. Now your net payroll multiplier is going to take your net revenue divided by total labor. So if you're not breaking out your labor, this is a ratio that you can use because it is looking at total labor. Your net payroll multiplier is going to be really important that you track because obviously this is determining your profitability. Little bit closer to standard here, so that's good. This just tells me that maybe they're a little bit has too much direct labor being charged. Maybe there's some inefficiencies on the jobs based upon the past ratio. Chargeability. So this is something that is really important that you're analyzing as an AE firm. Chargeability is everything, right? So again, direct labor divided by your total labor. So looking at this not only by a firm, but looking at your chargeability by person is really important. Most software out there can break down chargeability by person by division. This is just really important to track and understand. Are there some folks that maybe are too chargeable and need to take on a little bit more administrative work, or are there folks that need to do a little bit more chargeable work, and you need to look at them and how they're contributing to that bottom line. All right, overhead rate. So this is really important, understanding what your overhead rate is. And if you're not segmenting your costs, you're not going to be able to calculate this overhead rate. So if you are looking to get into the governmental space, understanding your overhead rate is going to be very important. So overhead, it's just your total overhead, your indirect expenses. That's your indirect labor, your rent, any depreciation you may have, any fringe costs for your firm, insurance, divided by your total direct labor. And that's going to come with your overhead rate. So this firm's overhead rate is higher than the industry. So PSMJ is saying you're in the industry standards about 165 right now. That's the median. So they're a little bit higher. They want to analyze why is that? Are they pricing themselves out of the market? Are there, excess overhead costs? Do they need to trim their overhead a little bit? So that's all important to look at. Certainly, this is driven by your, direct labor and your chargeability. So that all of this comes together, and these ratios work very well together to be compared to really get a true picture of your firm. All right, so net income before discretionary divided by your net revenue. So this is really important to see how much is left over before you distribute any profit. So I love this ratio. This firm probably not bringing as much to the bottom line to distribute as they'd like. They are on the lower median, the lower industry standard. Median level is around 19% this year. So again, really making sure that your financial statements can break out that net income before discretionary items and taxes, that your again, it's very important that you're just able to pick up your financial statements and pull these numbers right out of there and be able to calculate these ratios right off of the bat, so that you're not having to do a bunch of calculations to get to the number. So structuring your statements is really important. And again, if you didn't participate in the last webinar, going through that piece of it, I think is going to be really important that you sit through if your statements are not in the proper format right now. So let's talk about these operating ratios and what happens. So we work with a lot of firms from, the bat right off the gate that's just say, hey, like our financial statements are not in great shape. They're not broken out properly. I don't know if my folks are charging the time correctly between direct and indirect. So these ratios are going to mean nothing to you if people are not charging their time correctly. So I want to kind of break down what happens when direct labor is not charged properly. So this is something we work with firms on right out of the gate, because this is driving everything. So if you're not doing timesheets timely, if you are not segmenting your time on projects, then you're not going to be able to really analyze how your firm is doing. So what happens when direct labor is classified as indirect labor? So what is that going to do? So my employee doesn't know what they're doing. They are on a job overrun and they are burying their time in administrative. Well, that's not helping anything. What's it going to do? It's going to drive your chargeability ratio down for sure. Your net multiplier achieved is going to look higher than it really is. And then your overhead rate is going to go up. So in the opposite, if indirect labor is going to be classified as direct, because, whether they're not charging indirect time correctly, it's going to have the opposite effect. So chargeability is going to go up, even though they're not really more chargeable. Your net multiplier achieved is going to go down, and your overhead rate's going to go down. So that's a problem, because if you do bill out at an overhead rate and people are not charging direct and indirect properly, you're not recapturing those costs, because you're not going to be billing it, and you're also not recapturing it through your overhead rate. So really important. That's one of the first steps. If you're not there, reach out and we'll help you get there. We'll work with your staff to set up proper codes within their timekeeping system to ensure that direct and indirect is being charged properly. Staff ratios. So these are some great ratios for AE firms. So when I say technical staff, that's really going to be professionals who spend more than 50% of their time on chargeable projects. So when you see me talking about technical staff, if you see PSMJ referring to technical staff, this is their standard, 50% of their time on chargeable projects. Non-technical staff, what does that include? It's going to include administrative professionals, accounting, IT, marketing, those who are spending less than 50% of their time on chargeable projects. All right, so what is a ratio that you can look at? I keep saying that I love these ratios, and I do. This is another really great one. So your net revenue divided by total staff. So how much net revenue are you bringing in per staff? I think this is really important that you're analyzing this year over year, but also that you're comparing to your industry standard. So are you overstaffed? This is a great indicator if you are overstaffed. There hasn't really been any growth in this area. They've certainly grown in terms of net revenue and staff. However, they've maintained pretty flat net revenue to total staff. However, they're still way below the median. So something that you should look at. Your net revenue to total technical staff, another great tool to see how many technical staff is on average. Your net revenue per technical staff is on average for the industry. You can see, and potentially this is a market thing. This is an industry thing. Obviously, the PSMJ survey is nationwide. You can get this condensed to different geographical areas and not large cities, but certainly something to take a look at to see if maybe you're not charging enough or if potentially you're overstaffed. Net revenue to total project managers. Really great tool just to see what your project managers are producing. So targeted financial ratios. So we use a lot of targeted financial ratios in order to determine your own firm's growth. Okay, so those might be numbers you set when you're doing your budgets. Maybe your net multiplier goal is just over 3.0. Your chargeability at 63%. Your overhead rate at 155. So it's really important that you set targeted financial ratios for yourself and that you're monitoring those throughout the months. So that's something that we recommend that you're setting as a budget, that you're monitoring that. You're going to have ebbs and flows throughout the year. As you may be a cyclical firm. You may have times where you have significant backlog. So, but overall, you need to have a target of what you want to reach. So, achieving maximum ratios. So, it's not possible or even desirable to maximize most of the ratios. Again, it's understanding what is a good target for your firm. So your firm may have different clientele than other firms, and you may have a customer, a large customer that pays you every 120 days. Well, obviously your days sales and receivables aren't going to be that's not something you can control. That it is what it is, and you have to learn to manage your business in that sense. Current ratio. If you have a mortgage, and so therefore you have long-term debt that you have 12 months payable. You're managing your business a little bit different than maybe someone that does not have a mortgage on their facility. So all things that you need to look at when trying to say, oh, we're going to want to achieve the maximum ratio. Again, you don't want to look at these ratios and these industry standards in a silo. It's just really important that you understand what's right for your firm. So there is generally a goal to increase most operating ratios. Certainly that is something that you want to achieve as a firm. Increasing your multiplier is always a positive thing. Increasing your utilization rate is important. And monitoring that chargeability, really important. So I think that it's just really important that you look at your ratios and know the ones you want to maximize and the ones that you don't necessarily have control over. The ones that you don't have control over, I think you just need to manage them and making sure that you know where your targets are and where you want to stay and that you're in that range. So earlier I talked about how to incorporate these ratios into your everyday financials. So monthly, I encourage all of you to add some sort of analysis to your simple balance sheet that includes some of those top ratios. So whether it's your current ratios, whether it's your days fees, whether it's your days on unbilled fees and your WIP, those are really important ratios that you're looking at on an annual basis. So for that month, maybe you're looking at it from the prior month. Maybe you are looking at it 6 months out, or 6 months back, excuse me. So I think really analyzing the periods you want to look at. I love the annual year to date, and then looking at the prior month where you were at, and then the prior year 12 months ago. So that's really important to me. So again, this is all for whatever your company wants to look at, but this is just an example of how you can incorporate standard ratios into your everyday financials. So this is your income statement. Again, very important that you're looking at your income statement and looking at those key ratios. Your net multiplier, your achieved, your net payroll multiplier, your utilization chargeability rates, your overhead rates. In here I included before bonuses and after bonuses. Good figures to look at. Some years have high bonuses, some have lower. It's just important that you're understanding what your overhead rate is before those bonuses. And again, this is just an example, but this is a very high level financial statement. So I've stripped out all the detail, and then something I like to look at is breaking down that indirect expenses, still at a very high level. This is not the granular by your general ledger chart of accounts, but this is something much higher that you want to look at so that you can really see where you're at. So for my total overhead of 185%, where's the concentration? Obviously, it's probably going to be your indirect labor, but looking at that year over year and maybe 6 months ago is really a great tool. So I can see my indirect labor was at 63% at December 31st. And then a year ago, it was at 65%. But in June of this year, it was at 61%. So really understanding what's going on there. In June, maybe I hadn't paid out well, bonuses are broken out, so that doesn't help. But what's the reason for the percentage change? Did I have mid-year raises? Potentially that's what it is. Did we have, less jobs going on in the third and fourth quarter? So there was a lot more indirect time stuff. That's really, this is really good tools to help break out and let numbers just pop off the page to you so that you can analyze your business. All right, so how about these ratios? So earlier in my presentation, I talked about, PSMJ does a really great job at breaking down, architecture and engineering, the geographic location, how many employees you have. This is another statement that you could put together for your management group that shows where you're at compared to industry, and then you can break out some of the other categories for some of those key ratios that we talked about: current ratio, your receivable, your days in receivables, your days fees and unbilled, and then your multiplier and utilization. Okay, so this is, you'll get a copy of this. So just a great tool just to see high level where you're at comparing to some of the other tools that PSMJ provides. So something that's really important, we've talked about all these ratios. It's great that you put these on paper every month. What are you doing with them? So I think similar to my last presentation about the financial statements, it's great that you go through and you prepare all these financial statements. What are you doing with them? So it's really important that, one, you determine what ratios are meaningful to your firm. What do you want to compare yourself to? Is that going to be a target? Is that going to be an industry benchmark? Is that going to be a prior year? What is it that you want to compare to? That you're putting together the proper reports. And who is going to get those reports? So distributing them to the proper people is going to be really important, and that you're doing it timely. So it's the 16th of the month, and hopefully you all have your financial statement package for March already, that you are already diving into what happened in March so that you can make some timely decisions, to maybe make some changes in April, but also project what's going to happen in May. So really important that you're doing a timely analysis, and that you're performing an analysis at all, really. I mean, don't put all these reports together and then start moving on to the next thing. Without performing that analysis, it's useless. And then you've performed the analysis, great. What are you going to do with it? Do you guys meet as a project with the project managers to discuss jobs? Are you looking at your multiplier, your profitability? Are you looking at your WIP and ensuring that you're billing timely, that you're doing any timely write-offs? All of that affects your ratios. And it's just important that you're meeting on a weekly, bi-monthly basis to have those discussions. So great, have those discussions, but then it's really important that you make action. So what is the next step? Bridge that gap. And it's really important that you also document some of your analysis. So that's the next step. So document it. This allows that, so we've done this analysis this month. Okay, well, next month, let's pull it up. Let's see what we talked about last month. Have we made any changes? Has there been any growth? Did we take what we learned from the prior month, make some change? So many firms get to year end and they're like, what happened? So it's just really important that you're taking your statements and the tools that you have, and that you're helping make decisions to ensure that your firm is moving in a profitable direction. Some easy ways to document. You have these meetings. You could do a formal memo, but honestly, just recapturing it in a simple email that goes to all the distribution list is just as sufficient. Then you can pull that right back up the next month. Something I like to do, I do a lot of notes right there in the Excel. So if my financial statements are in Excel, I might make some key notes of some observations we made, and then it's right there. So it's clear, and then I can update those in the next month. So in conclusion, I think it's just really important that you consider your overall knowledge of accounting and the financial reporting process for your firm. So what is that looking like? With your firm, are your financial statements structured properly? Again, I'll share with you I'll have my marketing team share this past presentation so that you can have both in case you were unable to make it. But I think really making sure your financial statements are structured properly so that you're breaking out your net revenue, your direct labor, your indirect labor, and your indirect costs. That's going to be number one. Evaluating what reports you're seeing now and what could be produced, and if you're the key person that's distributing these reports, are you distributing to the right people? Are the right people coming to the meetings? Are you having meetings? That's all very important. What financial analysis are you currently doing? Can that be improved? And are you documenting any of that analysis? Are you guys taking the next step? It's just so easy for, the month end to happen. You race through month end, you get all the reports out, and it's like you're already on to the next thing. It's just I really encourage all of you just to take a step back, make sure that, you are taking the time to spend time and document your discussions, and then taking action. Taking action is going to be the most important. You can have these meetings, and every time you come to the meeting, you're going to be saying the same thing. So it's just really important that you have a good team, that you're going to take action upon some of these analysis that you're doing. And if you're seeing odd fluctuations, that you tackle them and get to the bottom of it quickly. Are there any questions out there? Right now, I don't see any, but I'm going to provide my email right here. You can certainly reach out to me. I work with a lot of firms, all different sizes and in all different situations. So if you have questions, we can help you with reformatting your financial statements, helping you implement some of these ratios into your monthly financial package. Obviously, I know all these, the back offices, not the front office, the back office. You guys are always short-staffed, and to try to implement some of these is difficult. So that's something if you need help doing, we have the manpower and expertise to help you in that area. And again, if you're not using a big package such as Deltek or Jira and you're on QuickBooks, it does not mean that you cannot have all these tools at your fingertips. Again, if you're not participating in PSMJ, highly encourage you to participate in that. It's certainly a huge tool for you to have at your fingertips to be able to compare your firm. And they can't do it without you. So, and I don't work for PSMJ, but I just love making sure that I get those ratios every year, and that, we're helping our firms achieve the most profitability that they can. So appreciate your time today. Hope you'll join us for our future webinars. And again, thank you, and please reach out with any questions.